Mr. Oluwaseun, if you can hear me, can you just drop a comment that you can hear me loud and clear? And if you can also see my picture, can you also drop a comment? Hello, Mr. Oluwaseun. If you can hear me and you can also see me, can you just drop a comment? Let me.
Yeah, I can hear you. I can hear you, but we can go ahead.
I can hear you.
Great. Okay. Good evening, everybody. Sorry for attending late. It was due to some technical issue, and we had to quickly resolve that. Sorry again for that. Anyway, let's continue from where we stopped in our last class on partnership, and from there we'll be fast. We'll try to be fast enough to go to another topic because the exam is fast spent and it's already. So, 1 second, sorry. Okay, so in our last class, we spoke about a lot of things in partnership, and we talk about the what partnership is and the forms of partnership, what makes up the partnership business, the difference between partnership and the sole proprietorship. We also talk about how the purpose and the objective of a sole proprietorship is, where of a partnership is, where we talk about the main purposes for them to make profits. And we says that partnership business is all about profit sharing, that's how they share their profit. And we also talk about the different type of method in which profit can be shared. That is where we talk about the notional profit sharing ratio and notional interest on long-term capital. We also spoke about where drawings is being removed from their business in the course of the business and how to solve that. So moving on, we talk about events where there is changes in partnership itself, and we talk about the reason why there can be changes in partnership, where if it is goodwill, accounting for changes in partnership, admitting new partner, and retirement of or death of a partner. And in our last class, I think we end in goodwill. We have to continue from goodwill, rather. So basically, what is goodwill? Goodwill is the amount by which the value of a business exceeds the value of all its net assets. So in our last class, I was trying to explain vividly that, for example, your business, you have a phone and you bought an iPhone for maybe 100,000 naira. Basically, if you want to sell the iPhone right now, you cannot sell it for, what do they call it? Well, you cannot sell it for that more than 100 naira. But because people have already trust you and they trust your business, your worth in the business is already valued after looking at what you have, the possession of your phone and everything you could have, and they say that, okay, this phone truly that is with you worth 100 naira. However, looking at you basically, that aside from the phone, you could be worth more aside from the phone. So they could have valued the phone 100,000 naira, and look at you as a whole person and value you for another 50,000 naira and say that, okay, this man standing here worth actually 150,000 naira. But mere looking at the man standing, they could have said, okay, what is in his hand that is worth 150,000 naira? They look at, and the only thing they could find in your body is just phone. And they go to the market and see that the phone is actually 100,000 naira. Then where is the 50,000 naira coming from? They will tell you that it is goodwill, because what is in your pocket and the amount at which you are being valued is greater than what is actually in your pocket. So the difference between the value of the business and the value of the net asset itself is called goodwill. So net asset actually, because I don't know if you understand what net asset is. Net asset is actually the total assets, meaning that non-current assets plus current assets minus liability, total liability is called net assets. So goodwill is an example of intangible asset of the business, but normally it is not recognized as an asset in the financial statement. The value of the business is usually more than the net asset itself. Then how do we calculate goodwill? Like I said in our last slide, that the value of the firm minus the assets, minus net assets will give you goodwill. Like the value of the firm and less the net asset will give you goodwill. Let's look at an illustration. I think I've explained this in our last class, and you were like, we should come back again to explain it. Example, a firm has net asset of 1 million naira. One of the assets held by the firm is a property at cost less accumulated depreciation of 400,000 naira. The property has a market value of 600,000. 200 above its book value. The value of the firm is the firm is valued at 1.8 million. Calculate your goodwill. Now, here they are telling you that the value of the firm is 1.8. However, there are two ways of calculating net asset itself. When you are valuing it, or when you are revaluing it, or when you are just using a normal depreciation value to look at it. Now let's look at when you are just using a normal depreciation value to look at it. He said the net asset already, the firm has net asset of 1 million already. So since the firm has a net asset of 1 million, this means that they have already calculated all the total assets minus their liability, which is giving you 1 million. Then someone is now coming to tell us that the firm itself actually worth 1.8 million. Then the difference, which is 800,000, where is it coming from? It's called goodwill. But what happens if you have actually revalued it in the market? Meaning that you are revaluing something is that in your own book, probably what you have is actually 20,000 naira. But by the time you go to the market and people are actually, how much is people actually selling this thing that you have is called the revaluation of an asset. So that is what they mean by revaluation. Actually, you could have used that 20,000 naira in your book to calculate your worth, but that is when you are not revaluing it, which is called without revaluing the asset. But if you are revaluing it, it means that you have gone to the market to see how much people are selling it, and you want to sell it at that price. That is what they are saying. And looking at that, they said one of the assets held by the firm is a property at cost less accumulated depreciation of 400,000 naira. Now, this asset, this property in your own book is 400,000 naira. But if you now go to the market, how much are they selling it to the market? They said it's 600,000 naira. Then where is the 200,000 coming from? It's an additional worth that you want to sell, because even if you now want to sell it, you don't want to sell it for 400,000. You want to sell it for 600,000 naira. So because you have revalued it, so this advantage of 200,000 plus this 1,000 naira, 1 million naira, makes it 1.2 million naira at fair value after you have revalued the asset. So the difference now, that how much is your firm worth, which is 1.8 minus the 1.2 is called 600 naira. Now, where is this 600,000 coming from? This 600,000 is known as the goodwill. It is as simple as that. So once the valuation of your assets, once your the value of the business is more than the value of your net assets, the difference is known as goodwill. So basically, how do you pass your journal entry in your goodwill is that because once you have this goodwill like that, then you have to debit something and you have to credit something. the difference, the amount you get for your goodwill, which is 800,000 naira, for example, how do you pass it in your books? So, like we said earlier on, that goodwill is an example of an intangible asset, an asset. How do you treat an asset? You debit all assets in your statement of financial position, and you now go ahead to credit your capital, because it means that your capital has actually increased with the same 800,000 naira. For example, the journal to recognize goodwill in partnership is debit your goodwill and debit your partner's capital. Okay, so let's move on to admitting a new partner. So when a new partner is admitted into the partnership business itself, so there are things to follow up with, to look into when such event is actually happening. What are these things? For example, one is that measure goodwill at old partnership business. Once you have measured the goodwill of old partnership business before someone else comes in, because you never can tell what this person is actually bringing into the table. Is it bringing his reputation into the table? Is it bringing in some bad representative into the business? Because the person that might actually be coming into your business, at the end of the day, people might look at it as, because we don't like this person, we might not be patronizing you. Because we like this person, then a lot of customers will actually be coming into your business. So prior to the time the person is actually coming into your business, you will look at the goodwill, the worth of your business itself before bringing in a new partner. So you recognize the goodwill, sharing the credit entry into partners' capital account, remove the goodwill in the books of the new partner sharing, and account for the capital introduced by the partners. So it's as simple as that. Like what they are trying to say here is, once you measure your goodwill of your old partnership business and you have recognized the goodwill sharing by sharing the credit entry of the partners of the old business. For example, A and B has a goodwill of 100,000 naira. A takes 50,000 naira since they are sharing it equally. B takes 50,000 naira equally. This same 50,000 naira, we have to remove it from the new partner that is coming in. So let's assume this new partner is bringing in 50,000 naira into the business. Then we are removing the 20,000 naira from each party that has goodwill of 10,000 naira each. So we are removing it from the 50,000 naira that this person brought as their new capital, and the money left for the new capital introduced by the new partner is 30,000 naira. It's as simple as that. Let's look at the retirement or death of a partner. When a partner leaves the partnership business, what are the criteria? What are the things to look at? What are the risks involved when a person leaves the partner? Is when a person leaves and when a person dies, is actually the same method, the same measures, the same step that we need to carry out when such things happen. The same thing, just like the previous one, that you measure the goodwill, you look at it, that what is this person actually bringing to the table? Because if he's leaving, what are the risks at stake? If he died, what are the risks at stake? Because even the death of a partner can even lead to the closing up of the partnership business itself. So you recognize the goodwill sharing the credit entry and to the partners of the old partnership in the old profit sharing ratio. Remove the goodwill in the books of the new partnership sharing ratio, sharing the debit entry to the partners of the new partnership in the new profit sharing ratio. Accounts for the capital taking. Amalgamation and dissolution of partners. Okay. So sometimes you might want to bring in two new partnership business together, and you can't just bring in two new partnership business into the business without following some steps or following some guidelines before you can do that. So there are some things that need to also look at in valuing the old partnership itself. It's similar to all these methods. If you look at it, this method is also similar to this one, and it's also similar to it. However, let's look at an example where amalgamation is happening. So it says that the statement of financial position of business immediately prior to the amalgamation and before any of necessary amalgamation adjusted will be as follows. AB and Co and CD and Co. We have non-current asset, we have current asset of 200, 100, 175 and 80,000 naira. We have capital for A, B, C, D respectively. And they have liability of 60,000 naira and 55,000 naira for A, B and Co and C, D and Co respectively. So then, what then happens in looking at these figures? In amalgamation, the only thing that actually happens is that we just add everything together. The two firms amalgamate with ABCD sharing profit or loss in 3, 3, 2, and 2 ratio. So the thing that just happens here is that they agree, we measure their assets together, we measure their liabilities together, measure their capitals together, then they have an agreement on what their new profit sharing ratio will take. It's as simple as that. So if you are to look at it, that what is A, B, C, D and Co total non-current assets, just 200 plus 175, current assets 100 plus 80, the total is going to give you 300 plus 225. The same thing with their capital. Their capital is still intact and they have a new profit sharing ratio. So that's that. The solution of a partnership. A partnership might cease trading when the following happens, or one of the partners decide that he wants to dissolve or liquidate the firm. So what actually might happen is that some of the assets of the firm are sold at a profit or loss, which must be shared between the partners in their business sharing ratio. The other one is other assets might be taken by the partners in part settlements of their capital. Another one is liability are paid, though some might be accepted by the partners or depending on what happened. So such that they have increase in capital as their balance. And the last one is the balance on the capital owned by the partners is paid off using the remaining asset of the business. Alternatively, a partner might have to pay cash into the business if there is a debit balance on his capital. So what is realization account? So because there are some cases whereby you want to sell your asset off and you don't know if you are going to be selling it off in loss or profit. So depending on what actually happened, you have to open your realization account if you want to dispose an asset. A realization account is used to calculate the profit or loss on the disposal of an asset. So if you want to sell an asset, you will have to open a realization account. This will make you to know if you're actually making profit or loss in your in preparing your if you are actually making profit or loss in is when you are selling your assets. So these are the formula of a realization account. Non-current assets, carrying amounts, current assets, inventory, receivables, cost of the solution, profits to the partners, capital and profit sharing ratio, proceeds from selling an asset taken by the partners. And if you have loss will actually be a loss to the partners in their profits or loss sharing ratio. Will also be if you have actually a loss. Let's look at an illustration on a full partnership business. Okay. Illustration 1, for example, we have Yerima and Boluke have been friends for some times, and they both had different business as a sole proprietor or a sole trader, and decide to form a partnership with effect from May 1st, 2017. Okay. Their respective financial position on 30th April 2017 is as follows. So we have Yerima, we have Boluke, and they both have their capital of 50, payable, loan from business. So this is capital, these are liabilities. We have our assets, we have our current assets, and we have our total assets. So for the purpose of the partnership formation, the following agreements were reached. First, premises were revalued. Okay, for Yerima, premises were revalued at 30 million naira and was to be used as an office earners, and the equipment value at 3 million naira was counted as obsolete. Some of the customers were found unable to pay their outstanding debt. Therefore, 2 million naira should be written off. The payables were paid out of the bank balance. Other assets were brought in the books at book value. Okay, now the first thing is that premises were revalued for Yerima, 30 million naira. It means that Yerima premises of 20 million naira, when they went to the market to see how much they are selling it, they're now selling it for 30 million naira. This is a revaluation. And they said they need to use this equipment in their office annex. However, the equipment that was valued at 3 million, so they have office equipment worth of 10 million. Out of this 10 million, they have a 3 million equipment that was counted obsolete, which means that the equipment is no more good, is bad, is old school, is late, so it's not useful. Also, some of the customers were found unable to pay their outstanding debts. Therefore, 2 million naira were written off. So out of Yerima's 10 million naira, 2 million naira was written off, which means that this 10 million naira will reduce down to 8 million naira. The payables were paid out of the bank balances. Other assets were brought at book value. What happens to Boluke? Boluke agreed to acquire out of private resource additional equipment costing 3 million naira to pay his payables from his bank balance, repay his loan by himself, and bring in his other asset at book value. What are they trying to say is that Boluke went outside his business and add additional 3 million naira to the office equipment. So initially, Bolu has 20 million naira and he had another 3 million naira, making 23 million naira. And he also pays these payables of how much? 1.2 million naira with his bank balance, and repay his loan. Now, he repays his loan by himself. So there are two different things that you are repaying loan, or like Yerima that repays his loan. Okay, they didn't talk about Yerima's loan. Oh, Yerima did not even have loan. Okay, it's fine. So he pays his loan by himself. So required, prepare the statement of financial position for the partnership of Yerima and Boluke, and state 10 provisions that should be contained in partnership agreement. Okay, now, so then what do we do? Sorry, 1 second. Okay. So now, what do we do is, what happens to Yerima's premises and equipment? What happens to Boluke premises and equipment? Let's look at it here. Now, basically, when both of them are merging together, their premises is supposed to be 20,000 plus 40,000 naira, making 60. However, these guy premises were revalued at 30,000 naira instead of 20. So we have 30,000 naira. And they didn't talk about anything regarding Buluke's premises. So instead of us having 20,000 naira for Yerima, we have 30,000 naira. So the 30 plus 40, our total premises will become 70,000 naira. For office equipment, basically our office equipment is supposed to be 30,000 naira, just 10 plus 20,000 naira. It's supposed to be 30,000. However, what happens to the equipment here? They said that office annex of equipment were valued at 3 million naira was already obsolete. So meaning that 3 million naira out of this 10 is already obsolete. So what does Yerima has left? Yerima just have only 7 million naira left. And what happened to Bulukemi? Bulukemi acquire additional 3 million naira, making 23 million naira. So from this 20 million naira, he acquire additional 3, making 23. Remember that 3 million from this guy is already obsolete, and Yerima office equipment is left with 7 million naira. So the 7 million plus the 23 million gives us 30 million naira. So this is where we are having our 100,000 naira. Premises, office equipment. Also, we have current assets. So did they talk anything about current assets? Well, the only thing they said is that all other assets were brought in book balances. So we have inventory of 2005. Receivables, what happens to receivables? I think they gave us information on receivables here. They said some of the customers were found unable to pay their debt. Therefore, 2 million naira was written off. So 2 million naira out of this 10 million naira for Yerima was written off. Then is left with 8 million naira. Did they talk anything regarding to his receivables? No. So 8 million naira plus 20 will give us 28. So while we are having 2.5 million naira for inventory, we should be having 28 million naira for receivables. 2.5, 28 million. So for our bank, for example, what happens here is that they said the payable were paid out of bank balances. So for Yerima has 500 naira payables in the first place, and it was paid for 500, this 5 million naira in the bank. Then what does he have left in the bank? We have 4.5 million left in the bank. The payables for Bolu was also paid in the bank to pay his payable from the bank balances. So he has a payable of 1.2. So if you are to remove 10 million naira from 1.2, you'll be left with 8.8 million naira. So your 8.8 plus your 4.5 will give you 30.5 million naira. 8.8, my calculation correct, yes, plus your 4.5, that is 13,300 naira. That should be what your bank is. Yeah, 13,300 naira. And for your cash, did they say anything regarding to cash? No, nothing was said about cash. So just add up your cash together. You have 14.5 for your cash. So you just add the rest that doesn't have information left. But now remember that in our calculation, Boluke was supposed to pay was supposed to pay his loan business from himself. Having paid their payable, none of them has, what do they call it now? None of them has payables to pay any longer. So since none of them has payables to pay any longer, then Boluke is supposed to pay his loan business of 20,000 naira. Boluke is supposed to pay his loan business of 20,000 naira by himself, and so we have a capital account So we have equity of Yerima 55,000 naira. This 55,000 naira. So what is the total of what Yerima is even bringing to the table once we add everything together? Yerima is bringing 30 plus his existing 7,000, making 37,000. 37 plus is 500, making 37,500 plus is 10,000, making 40,500, and plus 10,000, making 50,500. Okay, 55,000. So let me use my calculator here to, I think they should, do they have, okay, we have a calculation for the capital here. Okay, look at the capital, for example. So Yerima has a loan. He has a balance brought forward for 50,000 naira and 80,300 naira respectively. However, Boluke has a loan to pay with his own money of 20,000 naira. But then there was a revaluation gain. Did Yerima actually sell an asset? Yes, there was. So remember that one of the assets of Yerima was actually at market value that increases. Yerima assets, remember, was 20,000 naira in the first place, and this was revalued to 30,000 naira. So there was a profit of 10,000 naira in his revaluation account, which makes this profit 10,000 naira in the first place. And in his asset of 10 million naira assets, they said 30 million was obsolete and 2 million naira was actually written off. Then the difference between everything increases his capital for 5,000 naira. So this is where the capital increases in it when we are revaluing the asset of Yerima's account. So this was how we came about the 55,000 naira increase from 50,000 naira to 55,000 naira. And for Bolukemi, in his capital account, he has 8,300 naira and he has a loan of 20,000 naira. However, he bought another additional equipment, if you can remember, that he has another additional equipment of 3,000 naira. Then the addition of the total asset is contributing into the business is 103.3 million naira. Remember that he's supposed to pay his loan with his own personal money. So since we don't know his own personal money when he's going to pay, so he's coming in with the loan into the business as well. So that was why the loan is increasing. So, and the partners is actually not involved in paying the loans. So he's paying it himself. And what are the points? You can read up these points for your own, for the capital and agreement need to be made, the profit sharing ratio, agreement need to be made, what happens when interest on capital or joins is removed from the capital. So you read those 10 points alone. Well, there are several illustrations as well in where you can read and actually solve. So if you have any question as regards to that, you can easily drop your message. So you can actually try to solve this illustration 2. Illustration 2, especially this B, is actually a full examinable question. So you can look at it, and if you think you have any question, you don't understand anything, you can drop your message in the group. We will actually provide an answer to you. So because time is fast spent, we would like to go to another topic. Just ensure that you look at this illustration too. It's a key question, and it's an examinable question that could actually come out in partner as long as partnership business is concerned. So let's look at another topic itself. So today we'll be actually looking at an incomplete records. So what is incomplete record itself? As an accountant, you can actually be preparing accounting for a sole proprietorship who doesn't keep records of his accounts. he does not have bookkeeping, accounting, he does not. The only thing such person does is that he sells, he collects money, and once he remember that he's owing people money, he pays. And once he remember that someone is owing him money, he collects his money. So they really somewhat does not keep a proper book of their records. And they now call you to be their accountant and to keep their books, to prepare an account for them. Then you started wondering that something is actually missing in the books. So when you start seeing that some things are actually missing in the books, it's called an incomplete records. The fact that you are starting to ask some question and they can't actually provide an answer to it is known as incomplete records. So it's now left to you to know your ways of getting those records or putting those records back into a complete record. So there are ways of dealing with an incomplete record itself to make sense of the books. So for example, dealing with incomplete records is that you establish the value of the assets and you establish the value of the liability. So once you can establish that this is what you have, this person has a shop, he has a chair, he has a table in his office, and he's actually on loan with LACPO, those sole proprietorship, having loan. They won't call it loan in the bank. It's either from their job or from their contribution or from this LACPO people community. So then, if you can do that, you see that your asset is different from your liability and you find the difference between your asset and liability. The difference is known as your capital. Because such people does not even know the amount of capital they put into the business. And it is left for you as an accountant to tell them that this is the worth of capital you put into the business. Also, you can also use a memorandum control account, which is for receivables and payables in order to calculate your sales and purchases for the period. Sometimes you might not know the total sales this person makes for the year or for the month or for the week, but then you need to calculate them. How do you calculate them? You can easily look at, for example, if you're looking for their sales for the year, you look at it that, okay, last year you have 600,000 naira, this year you have 500,000 naira. So it means that there have been a decrease between last year receivables and this year receivables. It means that part of people from last year actually paid 100,000 naira this year. That makes their receivable decreases. Then you also go to the bank account and start looking for the amount of money they receive during the year. The money could not be any other thing. It is either your receivables from last year actually paid money this year, or the goods you sold that you made money from this year. So it's as simple as that. You calculate it, you add them up together. The answer you get will give you the sales you made for the year. Also, vice versa also works for the purchases as well, for you to determine this is the amount of goods the person make. For example, you also need to know the cash and bank transaction. You don't know this person keeps on withdrawing money anyhow. Today we withdraw money for the business to buy goods. Tomorrow we withdraw money for his own personal use. You look at it that, okay, where is this money going from? Where is this money going to? What are we using it to do? So from your payables account and from your receivables account, you can even easily go to see what this person is using his or her money to do, and you can actually calculate your cash and bank transactions. So also, we can also look at this accounting ratio of your gross profit margin ratio, or you can also use your markup on sales ratio analysis to get your inventory, in case you really don't know what your total inventory or inventory for the year is all about. But let's look at some illustration, and probably it will make more sense from it. For example, you want to get your total assets and you really don't know. Basically, we are always knowing our total assets and we are always knowing our liabilities. Just the capital, it's what we mostly don't know at times. So for this illustration, you look at it that your assets is equal to your liability plus equity. Another word for your equity is called capital. And then you look at it, okay, if you now want to calculate your equity or your capital, how do you get it? Then you realize that it is called asset minus liability is known as equity. However, like I said earlier on, even when we are calculating our goodwill, if you could remember when I was saying that the value of the business, if it is more than the value of its net assets, is known as goodwill. But then what is net asset itself? If you can remember, I said asset is, your net asset is asset minus your liability. So if you look at this formula here itself, you will see that this is also known as a net asset itself. So your net assets should always, at every time, most times, be equal to your equity. Anyway, let's move on. And so profit or loss for the period can be calculated from difference between the opening and closing net asset after adjusting for any drawings during the year. What does this telling us is that for you to know the profit for the year without even calculating your trading profit or loss or comprehensive income statement, you look at it that increase in net assets is equal to profit plus capital introduced. And our word for capital introduced is equity. Profit plus capital introduced minus drawings. So the profit figure can also be calculated in this practical format. Closing net assets. So closing net assets is simply asset minus liability and less your opening net assets. Now, this is supposed to be minus here. This is supposed to be less. And increase or decrease, the difference between these two, your opening and closing, let us to know if it is increase or decrease in net asset itself. You add up your drawings and so you reduce your capital during the year. And once you subtract your capital introduced by the owner, you get your profit. Let's look at an example. At January 1st, 2003, Tom's business had assets of 214,000 naira and liability of 132,000 naira. That is at the beginning of 2013. However, on the 31st December 2013, the business had an asset of 281. If you look at it, at the beginning, it has 214, and at the end, it has 281. What happens? There's an increase in an asset. It means that they bought an additional asset during the year. However, looking at the liability also increases from 132 to 166,000 naira. There's also an increase in liability at the same time. Tom took 25,000 naira in cash and 30,000 naira in goods out of the business during the year for his own personal use. So anything withdrawn for personal use from the cost of the business for personal use is known as drawings. He did not introduce any new capital, and hence what happens? How do we know the profit for the year? How do we know the amount of profit this person makes in the year? Then we look at it that, okay, well, the asset at the closing asset is 281. If you reduce your liability, if you subtract your liability from you have a net asset of 115. So this 115 is like your equity, your capital as at the closing of 2013. But then what is our capital as at the beginning of 2018 in the first place? We don't know. Okay. But in January 1st, we have 214 and 132. So the difference here between the 214 and 132 at the beginning is 82,000 naira. 82,000 naira is also like our equity at the beginning of the year. So if you are to less 82 and 115 together, it gives you 33,000 naira. So this means that this 33,000 naira basically, this 33,000 naira is part of the profits we make in the year. It is the profit we make in the year. But then, this guy still has the guts to remove 25,000 naira and 3,000 naira goods, making 28,000 naira. Remember that it did not remove the 28,000 naira in the 33,000 naira in the first place, because the question did not even say that he removed it from that. So you have to add it. Let's assume you did not remove it and we sold it off. Then you would have made profits. So you have to add this 28,000 naira back to the 33,000 naira. And if you add it together, you realize that this person actually make a profit of 61,000 naira. So the books, the accounts, the structure did not even tell us that this is the amount of sales they make, this is the amount of cost they make, but yet we can easily calculate our profits. So it depends on the angle the question is coming from, and you are going to look at the method at which you can attack it to solve whatsoever the question is asking you to solve. It's as simple as that. You can look at the alternative method at your own leisure time. Let's look at another example. I think this one talks about cash in the first place, because incomplete record is actually a likable question that always come out in foundation at this point, because it makes us it check you to know if you actually know your accounting principles, if you actually know your double entry principles, and you actually know how to determine each lines of accounts when it is being requested for, and even yet is not provided for. So they will not provide this information and they will still expect you to answer it. So during this method, they will test your incomplete record skills. Let's look at another example. At the start of the year, a business had opening capital of 350,000 naira. Profit for the year was 200,000 naira. The owner had taken 120,000 naira for joins. No capital was introduced. Then, at the end of the business, the cashier, this is at the start of the business, remember. So at the end of the company year, the cashier disappeared, Usalo. The owner was able to identify the following balances at the year end. PPE, property, plant and equipment, 95,000 naira, inventory, 85,000 naira, receivables, 65,000 naira, liability, 55,000 naira. Then we are told to calculate for the missing cash. How? Like, how are we into the business together in the first place? But you can't tell the examiner that you do not make business for him. So it is left for you to test your cash skills. Now, how do you know how much cash was missing? Because even me looking at it, do you even think if cash is actually missing? So then what are the things to look out for? The step one, work out the closing net assets. Remember our closing net assets. At the end, we have property, plant and equipment of this, inventory 85, receivables 65, and we have liability of 55,000 at the end of the year. So if you add everything together and let your capital, is going to give you 350,000 naira. No, it's going to give you, it can't give you 350,000. It's going to give you 190,000 naira. So which is your closing capital for your net assets. However, at the beginning of the year, we have opening capital of 350,000 naira, and we have profit for the year at the beginning. Remember that I told you that your net asset is always equals to your equity. If you could remember vividly when I was pointing it, say that in case they didn't give you this information, you can use the equity information. However, what is your equity in the first place? Your equity is always your capital plus your profit for the year. Your profit and minus your joins is known as your capital itself. So this asset minus your liability should always be equal to your equity. And here they said the start of the business, you have opening capital of 350,000 naira, we have a profit of 200,000 naira, and we have a joins of 120. So you have 350 plus 200 minus 120,000 naira. It's going to give you your net assets. So you look at those skills, those methods that, okay, this particular one now, they didn't give us PP, they didn't give us assets, they didn't give us liability, they didn't give us current assets. But how do we calculate our net assets? Which is also the same thing as your equity. So that was how they got their opening. We got our opening assets of 430,000 naira, and we have our closing asset of 190,000 naira. Now, identify the missing amount, 240,000 naira. So we can't find 240,000 naira in our account. It's as simple as that. The cash has only 250,000 naira. So let's look at one more account before we move into another method of calculating our sales or payables. Now you can actually look into it. And if you have any question, you can let us actually know. So you can just let us know the example you are referring to and probably the page also if you have any question. It's just so straightforward. So let's look at memorandum of control account. What does this particular account test? So this particular account is not part of a proper ledger accounting system. However, where there is an incomplete record, a memorandum account can be used to calculate the missing figure. Such figures are for mostly sales and purchases and probably expense in the period. So how to calculate the missing figure for sales, for example? The record for a sole trader might be incomplete because the trader does not keep any record of sales in the period. However, it might be possible to obtain the following figures. So we have the receivable at the beginning of the year, we have the receivables at the end of the year, and we also have money in the bank, and probably if you have cash with you, we also have the cash with you, and we can also determine if some people are actually going to be paying back their debt or not. And the reason why we can determine if some people can pay back their debt or not is probably they've left the country, they've run away, or they've died. Excuse me. So it's as simple as that. Where a business, So where a business makes some sales for cash, there might also be a figure for cash sales itself. There might also be a figure for cash sales where money has not been banked, like I said earlier on. The amount of this cash might be calculated from the sum of the increase in cash at hand at the year plus any expense paid in cash for which receipts are always available. Great. Let's look at an example. An accountant is looking through the records of a sole trader who does not have a bookkeeping system. He has established the following information: receivables at the beginning of the year, receivables at the end of the year, bad debt written off during the year, money paid into the business bank account. We have cash sales where the money was not banked. The sales for the year can be calculated as the balancing figure in a receivable memorandum account. Okay, I'm coming back to explain that. So then how do we determine the sales itself? How do we determine the sales? We have receivables for the beginning of the year. At the beginning of the year, 650. Now, if you are just picturing this, you understand how you can easily determine the sales. And the same principle also applies to purchases. If you want to know how you calculate your purchases also. So you have receivables at the beginning of the year of 650. It's just like saying, when you are waking up, you have 650 naira receivables. People are weighing 650 naira. And at the end, by the time you want to go and sleep, people are now owing you 720 naira. Like, what happened? Kilo day. So it means that you have sell another 70,000 naira worth of goods where people have not paid you. That is what it means. So you have sold another 70. You could have sold more. Like, you could have sold like maybe 1,000 naira goods. But then out of the 1,000 naira, just 70 naira worth of goods were not paid for as at the time you want to go and sleep. So therefore, we have increase in receivables. But then when we look at your account, we notice that you have even received money of 58,000 naira, 58,600 naira in your account. So when you wake up and before you sleep, what actually happened was that 58,600 naira have entered your account. What could that have been? It simply means that today alone, you sold worth of 58,600 naira again. Aside from the 70 naira that you could not receive the money, today alone, you receive 58,600 naira. However, remember that they said there was a cash too that you do not even take to the bank. Probably some people were paying you via cash and they could not pay to the bank. You receive how much? 300 naira. Also, out of the people that were owing you money, some could not be able to pay. And you look at it, because you are now a rich man, you said bad debt written off of 800 naira. It means that you sold goods of 800 naira. And probably along the line, something happens to people you sold goods to, and you could not be able to collect your money. You add all of this together. Remember, you have an increase in your people that are owing you of 70,000 naira, 70 naira rather. And by the time you receive money in your bank account today, you receive 58,600 naira. Some people pay you by cash of 300 naira. You sold goods to some people and they could not pay. You notice that they can't pay again of 800 naira. Then how much goods do you sell before you went to bed? 59,770 naira. Like, it's all about your skills, your techniques in knowing this accounting. It's so easy. The only people that can be owing you is people you sold goods to. Think about it. People that you did not sell goods to cannot be owing you. It's not possible. So the same thing, flip the case too. The only people you can be owing is people you bought something from. So if you do not buy, you cannot be owing people. If you do not sell, people cannot be owing you. It is as simple as that. And you look at the techniques that, okay, if you want to determine your sales, what are the key lines? What are the point lines you need to look at? The key action lines to determine your sales is look at the bank, how much money comes in. Okay? Look at your receivable, how much people are owing me in the beginning, how much people are owing me at the end. What is the difference? Are people owing me more? Are people owing me less? It means that if they are owing you less, it means that some people have actually paid their money. And you're fine, you're good. And notice now that if people are actually, let's look at this 720, for example. Let's look at, for example, if this 720 happens to be up here and this 650 happens to be down. Okay, so let's assume, sorry, 1 second, please. I'm trying to see some live feed here. Okay, so let's assume this 720 is actually in the beginning of the year and this 650 is actually the end of the year. Remember, what you are doing is you are not adding this 650 and 720, you are lessening them. So it means that this 70 will now be decreased. Look at, there's a bracket in this decrease. So this 70 will be minus. And by the time this 70 will be minus, it means that you are adding everything and you're subtracting this minus. And you'll be having 59,700 naira for sales of the year. So you just need to look at the technique that, is it increasing, is it decreasing, what are we going to do? So let's look at, for purchases, how do we determine our purchases, for example? So we have an example, payables at the beginning of the year is 1.2 thousand. We have payable at the end of the year is 1.8. Money paid out of the bank account to suppliers is 18,700 naira. Then what is your purchases for the year? Now you look at it, by the time you wake up, you are waking up because you could not sleep very well. You remember that you are owing people 1.2 thousand naira. And by the time you went to bed, you are owing people 1.8. Kilo shelle. It means that you bought another additional goods that you have not paid for, which is amounting to this 600 naira. So money paid out of your business account is 18,700 naira. But by the time you look at it, you realize that you have even paid 18,700 naira from your account that has left your account. It means that it's not as if that you bought only 600 worth of goods, but you bought the addition of 600 and 18,700 naira worth of goods, but you could only pay 18,700 naira. Then what is the amount of goods you bought during the year? 19,300 naira. Mr. Oluwaseun, if you understand, or if you have any question, can you just maybe drop a chat before I move on to your cash and bank account? Even if you're still following me. And no, I'm not talking to just my system. Hello, Mr. Oluwaseun. Mr. Oluwaseun. Hello? Hello?
Hello, Mr. Michael.
Hello, sir.
Mr. Sharon is not. Mr. Sharon is not responding, right?
Yeah.
Don't worry. Go ahead with the class. Finish your class.
Okay. So.
I'm with you. Sorry, sir.
Oh, okay. Okay, great. All right. So let's go on to memorandum, cash and bank accounts. A memorandum account can also be used to test record transaction in cash and through the bank account in order to establish a missing figure of the cash, maybe cash payment or maybe cash receipts, for example. So you could also be looking at it that, after checking your records, so even bank itself can actually miss your particular account to debit or credit your account, and you might not even know that money do not even enter your account, and even your client might have tell you that they send money to accounts, stuff like that. Then you wonder that, then how do we trace this? What do we put into figure? What do we put into place? What are the things we need to look that cash actually comes in, and total cash that it even comes in during the year? So what are things we need to look at? So you look, first thing as well, that one thing about incomplete record that we always love to look at is that we always love to look at the first year and the end of the particular year. So that is major thing we are always comparing most of the time. You know, when we are looking at the profit for the year, for example, we need to be looking at the total net assets at the beginning of the year and the total net asset at the end of the year to determine the profit that the business could make during the year. When we want to look at our sales or purchases for the year, for sales, we need to look at our receivables at the beginning of the year, receivables at the end of the year. We need to look at the bank and the money that comes in into our bank account. For payables, we need to look at, for purchases, we need to look at the payables at the beginning of the year, payables at the end of the year. We find the differences between the two, and also look at the money that left the account during the year. Then we add everything up to get our purchases. So these are the techniques we need to look at when calculating all this. However, for our cash also, not much also changed. We need to look at cash in hand and cash at bank at the beginning of the year. We also need to look at cash in hand and cash at bank at the end of the year also. So we also need to look at cash receipts, payment during the purchasing period, the period, for example, purchases, salary, and other stuff. But let's look at an example so we can actually make sense out of what I've been saying. So an accountant is trying to prepare the financial statement of a sole trader from incomplete record. A problem is that the owner of the business admits to have taken cash from the business, but he has not kept a record of how much he has taken. The accountant has established the following information: cash in hand at the beginning of the year, 200, bank balance at the beginning of the year, 2.3, cash at the end of the year, 500, bank balance at the end of the year, 3.5, receipts, 42.8, payment to employees, payment to suppliers, payment of interest or bank charges of 12.8, 17.1, and 400 naira respectively. So it is there for us to know the amount of cash this person will do during the year. Now, bank memorandum account. So we look at it that, okay, how much do you take at the beginning of the year? You took out 2,500 naira at the beginning of the year, and receipt, how much enters your account during the year? 45,300 naira at the end of the year. But then payment to suppliers, you paid suppliers how much? 70,100. You know, you can't pay what you don't have. So it's because you have payment of 70,100. You have money in the bank for about 45,300. That's why you can still pay 17,100. You pay employee 12,800. You pay interest 4,400 naira. The addition of this three gives us 30,300 naira. When you remove all this amount of payments from the amount of money that enters your account, then you have 15,000 naira. But then, how much are we having currently in our bank account? Or at the end of the year, we have 3,500 naira in our bank account. And how much do we have in our cash? 500 naira. So together, both cash and bank, we have 4,000 naira. Basically, we are supposed to be having 15,000 naira, both cash and bank. That is what we are supposed to be having. But now, this is now telling us that we have 4,000 naira in our bank. What is Jegbaru, man? So how does that happen? So it means that the difference between the closing balance of your cash at bank and the 15,000 naira is 11,000 naira. This person withdrew 11,000 naira from the account. Like, is that easy? Is that straightforward? There's actually no issue. So to determine your cash, you just need to look at the cash at the beginning of the year, how much money comes into the account, how much people did you pay, and then you have your cash at the end of the year. However, if the question is now telling you that the cash at the end of the year is different from the amount you actually calculated, then the difference is the drawings or missing figure that this person withdrew the money. It's that straightforward and that's simple. Okay, so let's look at another illustration. I think this is a real examinable question, and let's see if we can solve this one before we get to 11. Okay, so this is a November ICANN question 2018, still even recent, on incomplete records. Richard Jones keep incomplete records of his entity transaction. The entity's book value revealed that the net worth of 75,000 naira in January 1, 2017 and 3.25 million on, wow, is this figure correct? So 3.25 million on December 2017. During the year, Richard Jones sold his shares in some blue chips company of 2 million naira and also obtained a loan of 150,000 naira from his bank. The proceeds from both the sales of shares and the loan were invested in the business entity. He also took 150, okay, he took 150,000 naira cash for private use for the business during the year ended. Determine the profit made by the business for the year ended 31st December 2017. So we want to know the profit make for the year. So how do we say we are going to make our profits? How do we determine to make our profit in the first place? Remember I said the opening net assets minus the closing net assets will give you the profit for the year in the first place. So let's look at it. Okay. So Richard Jones. Okay, we have Richard Jones here. Okay. So we have capital at the beginning of the year is 3.25 million. You also had the drawings of 1.5, making 3.4 million naira. Then what is the net asset at the closing of the year? Remember when I said that your capital, your equity is also equals to your assets minus liability, and assets minus your liability is also net assets. So this is your net asset at the beginning of the year, and this is your net asset at the close of the year. The difference between the two is known as your profits. So net asset at the close of the year is net asset at this is 75,000 naira at the close of the year. Proceeds from issues of shares was 2 million. What did they say about this 2 million naira? He said during the year, now not at the beginning of the year, he said during the year, Richard Jones sold his shares in some blue chip company for 2 million naira. So this 2 million naira means that money comes in. And also obtain a loan. Now he now collected a loan. Another money comes in from his bank of 150,000 naira. So by the time you add all these two together, it gives you 225. It gives you 225. Okay. Here he took 150,000 naira cash for private use during the year end, 31st December 2017. Okay, this was where 150,000 naira comes in, where he took the loan. So you have a net profit of 1.175 thousand naira. So once you look at it, just like the example we saw initially on how to calculate your profit, your net profit during the your net profit at the beginning of the year minus your net profit at the end of the year, the difference between the two, your net assets, your net asset at the beginning of the year less your net asset at the end of the year, the difference between these two will give you your net profit. That is how to calculate your net profit. Because if you look at it, basically, it's like saying equity. And you know that in your statement of financial position, how do you treat your profit? You add your profit to your capital. So if you are saying that your capital is equal to your net asset, at the beginning of the year, you have your capital to be 500 naira. And at the end of the year, you have your capital to be 700 naira. And they said that you do not even add any capital contribution during the year. Then the difference between the two will be profit. So it's as simple and straightforward as that. But if you still ask any question, you can just put it on the group. During the class, we will easily actually answer you. Okay, moving forward. Let's say another question. We have another question, which this is actually a main question. Jaguar Enterprise, a distribution company, keeps incomplete books of an account, and the following balances were extracted from its books. We have prepayments, we have cash balances, we have bank balances, we have furnitures and fitting, we have inventory, we have trade receivables, trade payables, and motor van. Repayment is actually an asset, cash balances asset, bank balances asset, furniture asset, trade receivables assets, trade payables, liabilities, and motor van. So looking at this, you can even add everything and subtract them from your trade payable to determine your net assets. However, during the year ended 28th February 2018, the proprietor withdrew 350,000 naira cash from the business for personal use. Dividend of 5,600 from the proprietor, again, for private investment was lodged. Okay, dividend of 5,600 from proprietor's private investments was lodged into the business bank account as additional capital. So it means this time around we have an additional capital. Furniture and fittings to be written down. So written down, maybe something happens and to 68,000. The motor was valued at 500,000 at 31st March 2018. You are required to show a statement showing a profit or loss made during the year ended. So here also we are still even talking about profit or loss for the year. So it's also just like what we did for what do they call it, for Richard Jones. That is what you're also going to be doing for Django. It's like so simple and straightforward. So note, remember when I was saying we have bank balance and we have what do they call it, asset and our liability. However, if you look at this, if we had everything together, this is the beginning of the year. Oh, this is the beginning of the year, this is the end of the year. We have a negative bank balance here. So having a negative bank balance means we have a balance overdraft, a bank overdraft. You want to have a negative balance in your bank. It means that you have withdrawn more than what you have in the bank. And if you withdraw more than what you have in the bank, it means you are owing bank a certain money. By the time you deposit back, bank will collect it. It's just like you borrowing a credit from MTN. So it means that you have used more than the credit you have on your phone. So by the time you now recharge, MTN without queue will remove their money immediately before you even check your account balance. So the same thing with bank overdraft. So we calculate our net assets here by adding everything and less our trade payables. And by the time they did that, we did that here. So we have our trade payables to be 220 million. Is that what we have? Okay, we have our trade payable to be 200. I just want to be sure if I'm looking at the correct thing, and then we had everything together. So once we have everything, all our assets together, what do we have? We have total net asset at the beginning of the year is 4.905468 million. Our motor van is 600,000. I was expecting, why do we have motor van of 600,000? What does the book tells us? Sorry, 1 second. So we have motor van, furniture of fitting of 80,000, motor van of 600,000. And if you look at our question, we have motor van of 600,000, we have furniture and fitting of 80,000 there. I was looking for a motor van. I was looking at elsewhere. So you add everything together and subtract it from your trade payables, and you have your total net assets at the beginning of the year. The same thing also applies in your end of the year. You subtract everything, but if you look at this, I said our motor van at the end of the year was written down to be 68,000. Our furniture and fitting was written down to be 68,000. So from 80,000, it's now 68,000. So instead of you adding 80,000, you'll be adding 68,000. Our motor van also, which is now 500,000, from 600,000 is now 500,000. So instead of you adding 600,000, you'll be adding up 500,000. So those are the two additional information notes we need that is different from this at the beginning of the year. So what we'll be doing is adding 23 plus 41.8 plus, instead of this 80,000 naira, bringing in 68,000 naira plus 2.348 plus our trade receivables. So instead of using 600,000 naira for our motor van, we'll be using 500,000 naira. So this was what happened. The 500,000 naira, the 68,000 naira, and every other thing was added together, and they got their net profits, net assets at the close of the year. The difference between this and this, should give us our, the difference between those two should actually give us our profit for the year. But then remember that a new capital was also included, which is 5,600 naira was actually added into the business. So once you add that amount into your net asset at the beginning of the year, it increases it and find the difference, because this should be your new capital at the beginning of the year. So once you add it at the beginning of the year and subtract it, then you know if you are making profit or loss. So at the beginning of the year, the equity was 4.9. At the end of the year, after everything, we have 3.898. So the difference between this and this give us a loss. So you realize that this person is actually not even making a profit, but he was making a loss of about 1 million naira. So it's that easy and that straightforward. And let's see if we can. So there are other several questions, suggested solution that you can actually look at to solve. And if you actually have a question as in regards to incomplete records or partnership business, you can actually let us know. And if you don't, you can, and probably if you are just looking at it towards your leisure time and you're solving it and you see that you have a question, you can put it on WhatsApp or chat me up privately if you don't want to put it on the group. And if you don't have a question, I think that will be all for incomplete records. Basically, coming back again, let me do summary once again. That your incomplete record is when your accounts and the books is actually not complete. And basically, majorly what we are testing is for profit, is for sales, is for purchases, is for money that comes into your account, it's for your cash records purposes, and so on and so forth. However, if it is for your sales, I told you the key points you need to be looking at: the receivables at the beginning of the year, the receivables at the end of the year, money that comes into your bank account. If you are looking at purchases, you are looking at the payables at the beginning of the year, the differences between the payables at the beginning of the year and the payables at the end of the year, and the money that left your bank account. So those are the key criteria you are going to be looking at for your sales and your purchases, in case you are told to determine the purchases for the year and you were not given the figure. In fact, sometimes they will give you the necessary things that they're actually there for you to calculate, but then they will now tell you that you should calculate the profit for the year. And you'll be looking at it that we don't have sales, we don't have purchases. Then how can we calculate our profit for the year? But in there, they've given you receivables, they've given you payables figures where you can use it to determine your sales and determine your, what do you call it, your purchases. And then you can determine your profit from there. It's not necessarily you are using your profits, you are using net assets to determine your profit alone. But then if you are given information for your net asset, like we have seen in two different cases now, that your asset minus your liabilities, your net asset most of the time. But then sometimes they will give you an equity in the beginning of the year, and they'll give you liability and assets at the end of the year to determine your net assets. And the difference between the two will give you your net profit. So you just need to look at the information being provided and look at how you can maneuver the item key figure you need to be looking for. So if it is your net profit, for example, then you need to be looking at your net assets. So if you are looking at your net asset, then you are looking at asset minus liability, or you are looking at capital plus net profit during the year, at the beginning of the year, minus drawings. So those are the things you need to be looking at when you are looking at your profits. So I will advise you to look at this question. And if you actually have any question, do not hesitate to ask me in the group chat or privately. I'll keep on answering you. If I can't answer you all immediately, I will reply you that you should give me some time. Probably I'm busy or I'm probably in a meeting, but I will ensure that I answer you, even if it is to give you a call or to schedule another meeting. It's fine. So if you have any question, just let us know. And I will like to say good night. Thank you.